Auditor requirements in Denmark are often perceived as complex, but with a clear, structured view, businesses can navigate them confidently and use the rules to strengthen governance rather than seeing them as a mere compliance burden. In this video, we will walk through the key points your organisation needs to understand: when an audit is mandatory, how thresholds work, what types of audits and alternatives exist, and how to think strategically about appointing and working with an auditor in the Danish environment. Let's start with the basic principle. Not every Danish company is required to have a statutory audit. Denmark operates with size-based thresholds, and these determine whether your financial statements must be audited, whether a lighter assurance engagement is sufficient, or whether you can opt out entirely. For most limited liability companies, such as APS and AS entities, the decisive factors are net revenue, total assets, and number of employees. Danish rules are periodically adjusted, but the logic remains consistent. Smaller entities can often deselect an audit, while medium-sized and large entities are required to have one. As a broad orientation, a company that stays below specified thresholds for 2 consecutive financial years in terms of revenue, balance sheet total, and average number of employees can typically opt out of statutory audit, provided the shareholders approve the deselection and it is correctly registered. Conversely, once a company exceeds those thresholds for 2 consecutive years, or if it is listed, regulated, or operates in certain sensitive sectors, a full audit by a state-authorised or registered public accountant is usually mandatory. It is important to recognise that the rules apply at the group level as well. If you are part of a group, you need to consider whether the consolidated figures push you beyond the thresholds, triggering audit obligations, even if an individual subsidiary remains small. Similarly, some entities, such as public interest entities, financial institutions, and companies with listed securities, are subject to stricter requirements regardless of size, including mandatory audit, auditor independence rules, and in some cases mandatory rotation of the audit firm or key audit partner. For private owner-managed businesses, a key decision is whether to take advantage of the possibility to deselect the audit. Under Danish law, this typically requires a formal decision by the shareholders' meeting and appropriate disclosure in the company's articles and with the business authority. However, before removing the audit, management should weigh the broader implications. An audit often provides credibility with banks, investors, suppliers, and other stakeholders. It can streamline access to financing and may reduce the need for extensive additional documentation in credit processes. Some banks or counterparties may, in practice, require audited financial statements as a condition for lending or for entering into significant contracts, even if the law does not. In addition to a full audit, Danish regulation also permits alternative assurance engagements, such as extended review engagements, which offer more comfort than a simple compilation, but less than a statutory audit. These can be attractive options for smaller companies that want external validation of their accounts, without the full cost and scope of an audit. Choosing the right level of assurance requires a realistic assessment of stakeholder expectations, risk profile, and internal capabilities. When an audit is required, the company must appoint an auditor at the general meeting, document the decision, and notify the Danish Business Authority. The auditor must meet specific professional criteria and be either a state-authorised public accountant or a registered public accountant, working in a licensed audit firm. Independence and objectivity are central. The auditor must not have conflicting financial interests or relationships that could impair their impartiality. This affects how you structure advisory relationships as well. While auditors can often provide tax, accounting, and other advisory support, there are limits and safeguards to ensure they remain independent in their core assurance role. From a governance standpoint, many Danish companies, particularly larger ones, also have an audit committee or an extended board responsibility for overseeing financial reporting, internal controls, risk management, and the relationship with the external auditor. Even where not legally required, adopting some audit committee practices can be valuable. This includes formally defining the scope of the auditor's work, assessing audit quality, reviewing key findings with management, and monitoring remediation of control weaknesses identified during the engagement. Proper planning with your auditor is essential. Early alignment on timelines, key risk areas, significant accounting estimates, and any planned changes in systems or business structure can reduce disruption and prevent last-minute issues. For growing companies, it is helpful to periodically review whether your structure, financing, or expansion plans are likely to push you beyond thresholds and trigger new obligations in future years. For example, a business that is approaching the size criteria for mandatory audit should anticipate the need to formalize processes, improve documentation, and possibly invest in stronger financial systems before the audit becomes compulsory. International groups operating in Denmark should pay particular attention to the interaction between Danish requirements and group-level policies. The parent company's auditors may require that Danish subsidiaries be audited even if Danish law would otherwise allow deselection. Aligning audit requirements across jurisdictions can simplify consolidation, accelerate group reporting, and reduce the risk of surprises late in the reporting cycle. It may also influence your choice of audit firm in Denmark, with many groups preferring alignment with their global auditor to ensure consistent methodologies and communication. Another practical aspect is the potential liability and expectations placed on management. Under Danish law, the Board of Directors and Executive Management are responsible for ensuring that annual reports are prepared in accordance with applicable accounting standards and legal requirements, and for assessing whether the company is a going concern. The auditor's role is to provide reasonable assurance that the financial statements are free from material misstatement, whether due to fraud or error. This does not replace management's responsibilities. Rather, it provides an independent perspective that reinforces the credibility of the numbers presented to shareholders and other stakeholders. Businesses should also be conscious that the Danish Business Authority and, for listed or regulated entities, other regulators may follow up on audit reports, particularly if they include emphasis of matter paragraphs, qualifications, or references to material uncertainties. Such signals can influence how lenders, investors, and partners perceive the company. Proactively engaging with your auditor to address identified weaknesses or uncertainties and communicating clearly with stakeholders about remediation steps can mitigate reputational risk. From a cost perspective, many companies view the audit purely as an expense, but there is an opportunity to extract more value by using the auditor's insights into process efficiency, internal controls, and risk management. While the primary objective of the audit is assurance, many Danish companies use the annual audit cycle as a catalyst for improving finance function maturity, documentation discipline, and governance structures. Regular touchpoints with your auditor throughout the year, rather than only at year end, can help identify emerging issues earlier and spread the workload more evenly. To summarize the practical actions for businesses operating in Denmark. First, determine whether you are above or below the relevant thresholds, considering both standalone and group figures, and monitor these over time. Second, clarify whether you are subject to sector-specific rules or public interest entity requirements that mandate an audit regardless of size. Third, make a deliberate choice between full audit, extended review, or deselection where legally possible, taking into account stakeholder expectations and strategic objectives, not just compliance minima. Fourth, if you require or choose an audit, invest in a structured relationship with your auditor. Define expectations, coordinate timelines, and use their findings as input for continuous improvement of your financial processes and controls. Finally, remember that Danish auditor requirements are not static. Thresholds, standards and regulatory expectations evolve, often in response to European Union legislation and market developments. Building a basic understanding of the framework now and maintaining a periodic dialogue with your auditor or advisor will help your organisation stay compliant, credible and prepared for growth. If you are in doubt about your specific situation, it is advisable to seek tailored professional advice, as relatively small changes in ownership structure, sector or size can alter your obligations. By approaching auditor requirements in Denmark with a proactive, informed mindset, businesses can turn regulatory compliance into a solid platform for trust, transparency and long-term value creation.